Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Worthington Steel, Inc. quarterly report. Worthington Steel, Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Worthington Steel, Inc. trades at a lower price-to-earnings ratio of 15 times and a higher price-to-book ratio of 1.62 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 39% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. Worthington Steel, Inc. is a leading steel processor in North America, providing a wide range of products and services to various industries. At the core of its operations are carbon flat-rolled steel and Tailor welded blanks, which cater to the needs of automotive and construction sectors. The company's product portfolio also includes aluminum Tailor welded blanks, as well as specialized steel lamination stampings for automotive and electrical applications. These offerings enable Worthington Steel to serve a diverse range of industries, including machinery and equipment, heavy truck, agriculture, and energy. With its headquarters in Columbus, Ohio, the company has established itself as a trusted supplier in North America since its incorporation in 2023. Its extensive product line and sector-specific expertise make it an ideal partner for businesses seeking high-quality steel solutions. Worthington Steel, Inc. has experienced a significant surge in its stock price over the past year, increasing by 39.3% as of December 17, 2025. This growth can be attributed to several key news events and strategic developments that have contributed to the company's success. One major factor driving Worthington Steel's stock price increase is its strong financial performance. The company reported an 18% increase in net sales to $871.9 million, and a rise in net earnings attributable to controlling interest to $18.8 million compared to the prior year, fueled by higher direct volumes and selling prices. Additionally, the company declared a quarterly dividend of $0.16 per share. Worthington Steel has also made significant strategic investments in electrical steel production, which is expected to capitalize on the growing demand from electric vehicles, EVs, and data centers. The company invested $85 million in Mexico for increased motor lamination capacity for EVs, and another $85 million in Canada to boost transformer core-making capacity. Furthermore, Worthington Steel has reported gaining market share, particularly in cold-rolled strip and the automotive sector. The company has also announced a new patent-pending full-surface bonding technology for electrical steel laminations, aimed at improving efficiency and durability in motor cores. Additionally, Worthington Steel has begun integrating AI agents into its operations, expecting to reduce manual efforts and improve efficiency. Analysts have noted that Worthington Steel's strong revenue growth, expanding relationships in the automotive sector, progress in electrical steel, and adoption of AI support a positive investment narrative for the company. Overall, these factors have contributed to Worthington Steel's stock price increase over the past year. The primary drivers of revenue growth or decline in a company can be attributed to several key factors. On the positive side, net sales have been increasing by significant margins, with an 18% rise in Q3 2025 and 11% in HON 2026. Additionally, direct volumes have seen a substantial increase of 26% in Q2 F26, while average direct selling prices have also risen by 7% in the same quarter. Furthermore, higher equity income from Cervecero Worthington has contributed to revenue growth, with an increase of $12.8 million. On the other hand, toll volumes have decreased by 24% in Q2 F26, leading to a decline in revenue. Lower toll selling prices due to product mix and seasonal fluctuations in sales have also negatively impacted revenue. It is worth noting that certain factors such as tariffs and trade restrictions, competitive pressure on sales and pricing, and raw material prices have been mentioned, but do not provide specific information about their impact on revenue growth or decline. Net income and profit margins. A shift in favor of growth. The extracted summary reveals a mixed trend in net income and profit margins over the past year. Initially, net income decreased by 15%, page 2, indicating a decline in profitability. However, this trend reversed as net income increased from $16.1 million in Q3 2024 to $21.5 million in Q3 2025, page 7, and from $48.3 million in YTD 2024 to $60.1 million in YTD 2025, page 8. The year-over-year increase of 24.6% from $48.3 million in 2024 to $60.1 million in 2025, page 9, and a 46% jump from $12.8 million in 2024 to $18.8 million in 2025, page 44, further solidify this growth. In contrast, profit margins initially declined from 12.5% to 10.8%, page 2. However, the gross margin improved significantly, rising from 80% in Q3 2024 to 93.2% in Q3 2025, page 7, and from 11.4% in YTD 2024 to 11.9% in YTD 2025, page 8. The operating income margin also increased, albeit slightly, from 2.5% in Q3 2024 to 2.5% in Q3 2025, page 7, and from 3.9% in YTD 2024 to 4% in YTD 2025, page 8. The reasons behind these changes are multifaceted. Higher raw material costs, pricing pressure on finished goods, and increased competition initially contributed to the decline in net income and profit margins, page 2. However, the acquisition of Sitem Group on June 3, 2025, page 27, likely played a significant role in improving profitability. Additionally, excess tax benefits from share-based compensation, fiscal 2026, second quarter, page 26, and non-deductible executive compensation, and income from unconsolidated joint ventures outside the U.S. Fiscal 2025, 6 months ended November 30, page 26, also contributed to the growth in net income. In conclusion, while initial trends indicated a decline in profitability, the subsequent improvements in net income and profit margins suggest a shift towards growth. The acquisition of Sitem Group and excess tax benefits likely played key roles in this turnaround. The company's financial performance is a notable aspect of its overall success. One key indicator of this is the generation of positive operating cash flow. This means that the company is producing more cash from its core operations than it is spending on various activities. According to the provided information, the company has consistently demonstrated a positive operating cash flow over several periods. The most recent figure available shows an operating cash flow of $89.8 million as of November 30, 2025. This trend is also reflected in other reports and statements throughout the document, further solidifying this conclusion. The consistent generation of positive operating cash flow indicates that the company's operations are financially sustainable and able to support its growth and development. The company's debt level has undergone significant changes over the past year. Initially, long-term debt decreased from $151.5 million to $182.1 million, while short-term borrowings under the credit facility also decreased from $149.2 million to $110 million. However, a BDC loan increased from $0 to $21.2 million, and the overall debt level increased significantly due to outstanding borrowings, carrying an interest rate of 1-month Euribor plus 1.75%. Furthermore, current maturities of long-term debt and short-term debt have increased to $25.9 million. The carrying value of credit facility decreased from $149.2 million to $110 million, while the carrying value of outstanding debt, excluding credit facility, increased significantly from $2.3 billion to $72.1 billion. This indicates a substantial increase in debt levels, which may have contributed to changes in interest expenses. Interest expenses have also shown fluctuations over the past year. Initially, interest expense net was $0 in 2024 but increased to $0.1 million in 2025. However, for the 3 months and 6 months ended November 30, 2025, interest expense, net decreased by -29% and then -19%, respectively. Despite these decreases, interest expenses have also been reported to increase by $600,000, 28.6%, from 2024 to 2025, as well as by $900,000 due to higher average debt levels. Management's outlook for the company is centered around generating revenue through direct steel sales, toll processing, and market share expansion. They also plan to reinvest profits to drive growth. To achieve this, they are integrating AI technologies into their long-term strategy to improve productivity and decision-making. The company expects benefits from lower interest rates on its credit facility and anticipates easing inflation. However, seasonal fluctuations in sales may impact financial performance, with Q4 typically being the strongest quarter and Q3 the weakest due to tariffs and trade policy uncertainty. Management is committed to using non-GAAP financial measures to evaluate operating performance and make informed decisions. They also have access to adequate resources for at least 12 months and continuously monitor the economic environment to ensure liquidity needs are met. In terms of shareholder returns, management reviews dividend payments quarterly based on the company's consolidated financial condition, results of operations, capital requirements, and other relevant factors. This suggests a cautious approach to distributing profits while maintaining flexibility to respond to changing market conditions. The company has made several significant transactions in recent years. In terms of acquisitions, one notable example is the purchase of Sitem Group on June 3, 2025. This acquisition was mentioned in multiple pages of the summary, indicating its importance to the company's operations. Another acquisition, although with limited details provided, was also recorded in the summary. However, it is worth noting that this transaction did not receive as much attention as the Sitem Group purchase. On the other hand, the company has also engaged in divestitures. One notable example is the closure of a toll processing manufacturing facility in Cleveland, Ohio in May 2025. This move resulted in lower toll volumes from WSCP, indicating that it was likely a strategic decision to streamline operations and reduce costs. The company has a history of paying dividends to its shareholders. As per the provided information, the company has paid dividends for 2 consecutive periods ended November 30, 2025 and November 30, 2024. The dividend payments made during these periods were $16.5 million in 2025 and $15.9 million in 2024. The amount of dividend paid per common share is mentioned as $0.16. This indicates that the company has a consistent policy of distributing a portion of its profits to its shareholders through dividends. The payment of dividends suggests that the company is financially stable and has sufficient cash flow to distribute earnings to its investors. Concerns about inventory buildup and supply chain disruption. The extracted summaries reveal several concerns regarding inventory buildup and supply chain disruption. On page 3, the effects of sourcing and supply chain constraints are highlighted, indicating potential issues in meeting demand. The impairment of recorded inventory value on page 4 further suggests that existing stock may be overvalued or obsolete. Furthermore, an increase in inventories by $49.6 million in 2025 compared to a decrease of $62.4 million in the same period last year, page 9, raises concerns about inventory buildup. Industry consolidation has reduced the number of steel suppliers, making it more difficult and costly to obtain alternate supplies in case of a disruption, page 43. Additionally, toll volumes decreased by 24% in the second quarter of fiscal 2026 compared to the prior year quarter, page 44, and lower demand from mill customers is also reported, page 47. These factors collectively indicate potential supply chain disruptions and inventory buildup concerns. That concludes the financial summary for Worthington Steel, Inc. Feel free to comment below, and I will be happy to answer them when possible.